Hey everyone, today's Real Vision Daily Briefing is sponsored by Crane Shares. Learn about their KRBN ETF at craneshares.com/KRBN/Real Vision. Now to the top analysis of today's markets. Is the risk trade on? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Darius Dale, founder of 42 Macro. Hi, Darius.
Maggie, it's great to be back. How you doing?
It's great to be back. I'm doing well. And we are talking to officially a married man. Congratulations, Darius.
Thank you, Maggie. Appreciate you. Shout out to my beautiful wife, Allie, and her lovely family.
Well, we're so happy for you. And I'm sure the wedding was beautiful and everything you hoped it'd be. And I'm glad you got some time off. I'm sure our fabulously wise community probably has some great marriage tips for you. So if there's anything you want to share to Darius, bring them on in, put them in the chat.
I heard the best one is happy wife, happy life.
Yeah. I'd say that's a good one to start with for sure. So, boy, you really like pop right back into the action, didn't you? Because we had an action-packed week, a lot of information. We had the tame inflation readings back-to-back, CPI and PPI, which really set the market off. We had bank earnings today, JP Morgan, Citigroup, better than expected. Consumer confidence really blowing past expectations, a 2-year high. When you put it all together, and stocks, by the way, which are a bit flat right now, but stringing together a really nice-looking rally. When you put it all together, Darius, what are you thinking about? What do you make of all this?
Well, I make of all this was to be expected. I mean, this is something we've been talking about on the program since almost a year. I mean, it goes back to last August when you and I were discussing our resilient U.S. economy theme. I'd come on the program every week and say, the economy's booming. The economy's booming. The economy's booming. Now, it obviously slowed down since that time period, but we've been very consistent since last fall that the U.S. economy would remain resilient, at least until you get into Q4 this year and or Q4 of next year. That's when we have the recession timing. So let's unpack some of the data that we got today, because I think it's very important to contextualize this stuff in order to understand where we're likely headed next. So, Brian, if you throw up chart 3, where we show the University of Michigan Consumer Sentiment Index, we show the Current Conditions Index, and we show the Expectations Index, and we see just on a headline basis, the headline ticked up by 8.2 points to 72.6. That 72.6 is the highest number we've seen since last September of 2021. But more importantly, that plus 8.2 delta is the fastest month-over-month increase we've seen in this time series since December of 2005. So, I mean, this is pretty clear in our view what's driving this improvement and in consumer confidence and ultimately the resiliency of the consumer economy here in the U.S. is what we show on slide 4. Brian, if you throw that slide up where we show immaculate disinflation has been a contributing factor. As the top panel in this chart, we show the expected changes in prices over the next year. The median statistic, that number ticked up very marginally, 3.4, but it's down from right around 5.5, about a year ago. And so that immaculate disinflation and expectations amongst consumers has really contributed to an improvement in their expected financial situation over the next year, which is the chart in the bottom panel in that chart. And that number is up plus 8 points on a month-over-month basis. That's the highest level we've seen since July of 2021. So when you put everything together, we've had a considerable amount of immaculate disinflation in the economy. It's inflated consumer incomes both on a real and expectations basis. And ultimately, we've been able to hang in there from the perspective of consumer spending, and hanging in there from the perspective of consumer spending has really kept the labor market buoyant, which are all things that we presaged in these conversations last fall.
Yeah. So I guess it's funny that you say the immaculate disinflation, because there were so many doubters, right? I mean, when you first started talking about that, we really had people divided in camps, and so many people just didn't believe it. They thought the economy was about to crater. This recession timeline has been getting pushed out so much. In fact, Andreas, I'm gonna run this now because it's right in line with what we're talking about. Andreas dropped the latest episode of Steno Signals, and he gives some more meat on why this recession has been so hard to pin down. Let's listen to that, and we'll talk on the other side.
Let's have a look at 4 reasons why the recession risks proved to be overpriced, and why the recession can ultimately still arrive, but ultimately you also need to look for clues on the actual recession to actually take notice of it, or to care about it from an asset allocation perspective. And the first reason I'd like to highlight is the relationship that we see between real wage growth and labor demand. So wage growth adjusted for inflation. What we saw through 21 and 22 was an outright nosedive in the wage growth adjusted for inflation. And what that means is that companies set higher selling prices relative to the wage component of their cost base. So in my humble opinion, this is positive for most companies because they pay less for their workers relative to their selling prices. And interestingly, you also get that exact pattern when you study it empirically. When there's a slide in the inflation-adjusted wage growth, companies tend to hire more people, which makes sense given that the price of labor has cheapened relative to their selling prices. And currently, we're seeing sort of the opposite scenario slowly but surely unfolding, wages growing faster than selling prices. And that could turn into an issue for the labor market, say 3, 4, 5 months down the road, as the price of labor gets more expensive relative to selling prices. And I actually think that is the way that you should look at real wage growth relative to labor markets. And it's completely upside down relative to what most economists will tell you.
And that full episode of Steno Signals is available on our website. If you're not already a member, you know what to do. Scan the QR code and you can hop on a trial. So Darius, where are we in terms of, you've been, as you said, you've been flagging this and sort of, warning people that the recession talk was, or the recession calls were maybe premature. Where are we now? Are you worried about wage inflation? I know you have a chart that is, when will immaculate disinflation conclude? I think that's what we're all wondering. Are we in this sweet spot and the Fed's going to get away with this soft landing where inflation's tame and the economy's doing well? It sounds too good to be true. What are you thinking about in terms of timing?
You're 100% correct in terms of identifying this as a sweet spot. We are in a perfect sweet spot of immaculate disinflation. And so the question is when does this sweet spot end, or when does that driving force of immaculate disinflation conclude? And so we posed that question on slide 6, Brian, if you could throw that chart up, where we show median CPI on a 3-month annualized rate of change basis in the blue bars, and the red line is the year-over-year rate of change. We saw Trimming CPI in the second panel, and super core CPI, which is core services CPI ex housing, in the bottom panel. And what we've seen is that if you stick with the bottom panel, that immaculate disinflation that we've seen has really showed up in this sort of statistic that Powell and other central bankers are watching. We've seen the blue bars come down from a kind of a 6-month moving average of around 4% to breaking down all the way to 1.4%, which again means that the 3-month annualized rate of change of super core CPI is now down at 1.4%. That's the lowest print we've seen since September 21. So that ultimately means that the year-over-year rate of change is going to chase that lower. Similar dynamics we're observing in median CPI, top panel, trim mean CPI in the second panel as well, where we have the 3-month annualized rate of change now down at 4.6%. That compares to a 6-month moving average of 6. We have trim mean CPI at 3.1%. That compares to a 6-month moving average of 4.6. But what concerns me about this immaculate disinflation that we've observed, and again, we got all these data points this week in the June CPI report. What concerns me about that is the stasis that we're starting to see in median CPI and trim mean CPI. And this goes to the point we've been making in recent discussions, is that immaculate disinflation is immaculate for a reason, right? We don't just make these things up. And the reason we call it immaculate is because it's very atypical. In fact, it's highly unusual to see such a breakdown in inflation ahead of an observed recession. Typically, inflation is the most lagging indicator of the U.S. business cycle, typically breaking down somewhere around 2 to 3 quarters after a recession begins. And so ultimately, we understand that this immaculate disinflation process is going to conclude, and we're going to be left with higher rates of inflation relative to trend, higher rates of wage inflation relative to trend, and ultimately, we're going to need that recessionary process to get inflation back to 2%.
Okay, so that is going to be disappointing to some. Oliver was asking, Darius, will my Friday night drinks cost more or less by the end of the year? Sounds like you're saying they're probably going to cost a little more.
Well, the disinflation in the rate of change will slow down. I mean, that's
Yeah.
I don't want to say specifically about the alcohol, food, and beverage category, but what we're seeing is we're starting to see a little bit of stasis where it matters. And in terms of these median CPI, trimming CPI time series, so we're going to continue to see year-over-year inflation, particularly core inflation, head lower and chase these the 3-month annualized rates of change down. But what concerns me, looking at other indicators, focusing on, for instance, the ISM services or ISM manufacturing supplier delivery time surveys, those numbers are, months ago got back to levels that are more consistent with 2% inflation. You look at the housing indicators, we have a resurgence in housing inflation, citing the fifth home price index. It's now up 9% on a 3-month annualized basis. You go back to the lag, you interpolate the lags from the current cycle, and we might see a soft rise in housing inflation over the next couple of quarters, because that's what it did roughly 18 months ago when, kind of interpolating that lag back to the time series. So, there's some things that could have you concerned as an investor about this today being the crescendo of the soft landing, the peak in the soft landing expectations, the peak in immaculate disinflation expectations. And it could be the case that from here, soft landing starts to decay, immaculate disinflation starts to decay, and both of those get replaced by something called a recession and sticky inflation. So that's where I suspect we'll be in a few months' time. But between now and then, just like any other period in mismanaging financial markets, you just have to lean on your technical indicators.
Yeah. So I want to touch on a couple other things as we're talking about the turn. So you're looking at changes maybe in the best news of the inflation being, the falling inflation maybe having peaked. You also, I think, point out some really interesting factors that are contributing to our resilient economy, because a lot of people are scratching their heads. And we often talk about, maybe it's the haves and have-nots, right? We know that some people who are living paycheck to paycheck or toward the bottom of the economy, the income, stacking order, right, are struggling a little bit, and maybe those who are wealthy have more. But you have some other things on here that are really interesting. Walk us through some of these. I'm especially interested in seeing limited credit cycle vulnerabilities. I thought that big rate reset was going to really hurt, when it came to credit. We haven't really seen that. Walk us through some of these.
Yeah, well, so I'll start. There's a few things you said that are worth unpacking. I'll start by saying, as someone who grew up very poor in and out of homeless shelters, we are always struggling.
Yeah,
poor people are
that
always
is the
struggling.
truth. Right.
Yeah,
No matter what's happening, there's a part of the economy that is always struggling. You're
exactly.
absolutely right. Yeah.
Taking to Twitter and just so suddenly concerning yourself about poor people is not how you do financial market research. So let me make that point very clear. But putting up this slide 5 in slide 5 in today's chart pack. We list these sort of key factors that are contributing to our resilient U.S. economy theme, and many of these factors, by the way, were ever present when we created the theme almost a year ago. So let's run down the list. We have near record cash on household balance sheets. We're right around $4.5 trillion in checkable deposits. That number is up from around $1 trillion prior to the pandemic. So this concept of excess savings and dwindling down and lower income consumers running out of excess savings is all Wall Street nonsense. Just slap it down, move it on. It's Wall Street nonsense. You heard it here, folks. Near record cash on corporate balance sheets are right around just shy of $2 trillion. As a share of both of those cohorts' total assets, household and corporate sector, that $2 trillion for the corporate sector, that $4.5 trillion for the household sector is right around 3% of both of those cohorts' total assets. You got to go all the way back to the mid to late 1960s to see a ratio of cash on corporate and household balance sheets this high, which means both businesses and consumers still feel rich. They're flush with cash as a share of their total assets. Another factor is that private sector income and wealth have outpaced inflation on a structural basis. You look at, again, those statistics themselves, you add money market fund exposure into that, you add household net worth into that, you add nominal employee compensation into that, you add gross domestic income into that, looking at the business sector, and all of those factors have outpaced the growth of inflation since the start of 2020. And so on a structural basis, inflation is going to catch up, but it's just going to require time to catch up and make those things negative on a real basis. We also have limited credit cycle vulnerabilities. One thing that, I've learned from studying business cycles for, 15 years is that you tend to need to see, in order to have a recession, you tend to need to see Two factors. One, capital misallocation and financial tightening. We've had financial tightening, and we're going to continue to get financial tightening as it rolls its way through the system on a lag. There's long and variable lags in monetary policy based on the term of debt and, duration, et cetera, all that stuff. But what we have not seen in this business cycle is a growth rate of credit that would be commensurate with capital misallocation. Everyone keeps talking about credit card debt this, credit card debt this. Again, terrible statistics. Credit card debt as a share of nominal disposable personal income has not budged since 2015. It's literally been like a flat line dead person heartbeat since 2015. So, you got to do the statistics correctly if you want to understand these things and ultimately make money with this information. And so we've got a couple more things. We have very limited exposure to the volatile manufacturing sector in the U.S. economy. The manufacturing sector accounts for 14% of total non-farm payrolls. That's down from like 45% in the 1940s. It accounts for 18% of GDP. We only get the statistics since 2005, but it's obviously on a secular low. And the reason I bring that up is because when you look at recessions, the sector of the economy that accounts for most of the job loss in recessions is the manufacturing sector at around 98% of net non-farm payroll job loss. And so you got to do a lot more damage to a tiny part of the economy in order to really create a recession. And the problem with creating that and even doing that is that one large chunk of the manufacturing sector is the housing sector. And we have this boom in new home sales because we have this record spread between the marginal mortgage rate and the effective mortgage rate. So it's like, how are we even going to do that, right? And then a couple final things, I'll be quick. Labor hoarding, we obviously see the labor force as low relative to the trend. And so gross domestic income is high relative to its pre-COVID trend. And so as a function of that, you're obviously seeing companies being very unwilling to let go of talent, early in the business cycle downturn. And then finally, which is arguably the most underappreciated factor on this entire page, which is Bidenomics. We have a president that thinks it's a good idea to spend money to take inflation down.
Yeah.
He said it a year ago. We laughed at it. And now a year later, he's doing it. We have a record non-war, non-pandemic, non-anything fiscal budget deficit. Like we've had deeper budget deficits, obviously, but during recessions, but not outside of recession. We've never seen an 8% budget deficit to GDP here in the U.S. economy. So that's obviously contributing to the resiliency of the economy and ultimately what we think by, a quarter or two from now may contribute to the resiliency of U.S. inflation prior to, the recessionary process that it needs to get back to 2%.
Yeah, interesting. And we are going to talk a lot more about that. You're right. It doesn't come up as much. We're going to talk a lot more about that, as we turn the corner, I think, into the fall. It's on our radar, certainly, but I'm really glad. I'm so glad you put this list down because I think sometimes people scratch their heads and as you say, rely on sort of information that's floating out there or a line you hear someone say, or I think we all sort of have financial insecurity. So we're like, wait a minute, things don't feel that good, but this is a really comprehensive list. So my question is, do these factors mean that even if we go into recession, it's not a severe one?
Yeah, it's highly likely to not be severe. So let me answer that question two ways. From an economic standpoint, it's unlikely to be severe because again, we're talking about, labor hoarding that may be persistent even in a recession. It may just be harder to get rid of headcount because again, ultimately companies know that in the next expansion, if they fire too many people now, they may not be able to replace those people when they actually need to grow again.
Right.
So that's an issue. So that's one thing that can contribute to this. But going back to the limited credit cycle vulnerabilities, one thing that we found is there's a pretty sharp statistical relationship between what we call the private non-financial sector credit gap. Now that's a very wonky academic jargon for the deviation from trend in credit to GDP ratio for the private sector. And our deviation from trend is actually negative in the sense that we have not levered up and certainly have not levered up at a quick enough pace to suggest there's any capital misallocation in the economy. And
so that's saying that corporations are in pretty good shape. They're not overextended with credit. Yeah. They've got a lot of cash on their balance sheet. So it's a pretty healthy corporate sector, which should help insulate when we hit some trouble.
The reason that matters is because that health you just cited is inversely correlated to the depth of the recession, both in terms of the drawdown in GDP, and also in terms of the drawdown in non-farm payrolls. And so we have like one of the shallowest credit gaps ever, ahead of a recession in the U.S. economy. Now the data comes out in a lag from the BIS. It's going to get worse, but it may not get worse enough to suggest that we're going to have anything other than a mild recession. Now that's the first half of my answer to your question, Maggie. Mm-hmm. Second half of my answer to your question, Maggie, is I don't think the market's going to care about how mild the recession is when it starts. And the reason I say that is because typically what causes the market cycle to inflect in a recession is the response in policy. Obviously, the Fed was very ineffective in 2001 and ineffective in 2008 in terms of its pivots. But generally speaking, by and large, the bear markets tend to bottom right around 1 month ahead of the inflection in 1 month after the inflection in the liquidity cycle. I've done a tremendous amount of work on this, probably as much work on this as anyone in the world, and I will challenge anyone to put their work against ours on this. And so what we tend to see is that the Fed tends to cause bear markets to inflect. And the reason I bring that up as a negative value is because the Fed is implicitly forecasting a recession. If you look at the implied deltas on their summary of economic projections on unemployment, on core PCE, they're telling you higher for longer. They say it every day, every week. And so my fear is heading in when we get into that phase 2 credit cycle downturn process, which may be a few months away or a couple of quarters away. So that's kind of our modal outcome expectation. When we get into that process, it's very likely that the Fed is going to be sitting on its hands and not supplying the market with liquidity in a panicked fashion like it did in COVID, like it did in previous cycles. And that concerns me from the perspective of how much the market needs to go down to get the Fed off its high horse.
Yeah. Okay. So that's super interesting. And we started this by saying, is the risk on trade or is the risk trade back on? Because some people are feeling like that. They're seeing what's happening in stocks. They saw that inflation come down but it sounds like you were a little skeptical. And let me ask, Saul has, I think, the same question. He says, big fan, great talk on macro voices. I might be late to the party, but does the market narrative need to shift from higher rates equals recession more likely to strong growth, productivity equals SPY to the moon before prices are affected by the credit cycle downturn?
Yes, probably. Yes. And that's exactly what we tend to see. So markets, by the way, markets are always very strong in the year leading up to recession. This is something we've done work on a couple of quarters ago, maybe, whenever we put it out. But the reason I brought this up, about a quarter ago. The reason I brought this up is because, the markets not only are very strong in the year leading up to a recession. On a median basis, the return to the S&P 500 is plus 16% with an interquartile range of plus 14 to plus 20. But that's obviously the fear is if you're a bear or someone who's not participated is you don't want to capitulate at the end of that process. What if today is the high, right? So what we also done a bunch of work on is try to help investors understand, okay, when does the market tend to peak ahead of the recession? And on balance, it's about a month ahead of the trough in unemployment and also a month ahead of the breakout in jobless claims. So obviously, if you're watching jobless claims like a hawk, and we have a bunch of statistics on what to actually watch within the report from a rate of change perspective to give you an indication of whether or not it's a recession, but that's neither here nor there. If you understand that the market tends to peak right around a month ahead of the big breakout in jobless claims, then you understand that we probably have some time to price in more right tail risk between now and let's call it Q4 of this year or Q1 of next year is when we think the recession process might commence. Let's just use, I'm totally making this up, so be aware of this. So let's just say the recession starts on December 31st. That tells you the market probably should peak sometime in November. The recession starts on March 31st. The market should peak sometime in January or February. And so again, I want investors to understand kind of the key takeaway from that analysis. And one final thing, it's a key takeaway from that analysis is you tend to see that squeeze. So what happens? The reason markets are so strong leading up to recession is because everybody on Twitter or whatever the version of Twitter was in previous business cycles, whether it was the news wire or the water hole or the golf course was probably it. It's whatever that was. When people would get together and they'd all figure out that the cycle was slowing, but they didn't realize that there's this thing called time and respecting the x-axis from the time you recognize the cycle slowing to the time that the market is done, pricing in the latter stage of the business cycle.
So timing this recession is really important then. Timing when it's starting to roll is going to be critical, right?
It's the only thing that matters in financial markets is time.
So
it's the only thing that matters.
I'm taking a deep breath in because that is the damn truth, isn't it? So the problem is everyone's having a hard time with this because they've been moving out. They've been expecting it. It hasn't happened. They've moved it out and they're missing this rally because they've been sitting on the sideline looking for an opportunity to get in. Sandeep asking, what are your thoughts on global liquidity and U.S. liquidity? How does liquidity fit into this when you're trying to figure out the timing and when the market is going to roll over here?
Great question. Let me answer the first question from Saul real quick because you mentioned something I think is important to bring up. If you're underinvested. We have this theme called patience and popcorn, which means patience if you are a bear. Don't run out trying to short because we know the market's going to squeeze, well into the doorstep of recession. Popcorn is if you're underinvested, don't get fully max allocated and fully invested at this particular point in the cycle. Obviously, you need to have some exposure. We're not advocating for obviously with this research view, we're not advocating people not participate, but don't be fully invested or getting fully invested because we understand that this is probably going to conclude at some time. So that's what we mean by patience and popcorn. You want to be getting fully invested at the lows of a market cycle, not 3 or 4 months ahead of the peak of the market cycle. And that's what we've been trying to communicate. I think we've done an effective job of communicating that to our clients. Sorry, you asked a question on
global liquidity. Sandeep asking, what are your thoughts on global liquidity and U.S. liquidity?
Let's just put up slide 2. We have our global liquidity cycle monitor. We update this in every piece of research that we publish at 42 Macro. So you can kind of under that under the word MON in monitor, you see our liquidity proxy. So for the global economy, Chinese economy, U.S., Eurozone, Japan, U.K., India, Switzerland, Brazil, these are all the countries that feed into our global liquidity proxy. And so what that is, the 42 Macro global liquidity proxy is the sum of these central bank balance sheets, the sum of their broad money supply, and the sum of their FX reserves minus gold. And as what you can see is that we're currently trending lower on a global basis. We're trending lower in China, although we do expect Chinese liquidity. It has inflected. It's going to inflect into a positive trend in subsequent months. So we're actually quite bullish on the Chinese liquidity cycle and obviously the related implications of that. U.S. liquidity is going to continue trending lower. Eurozone liquidity is going to continue trending lower. Japanese liquidity is a total wild card. Part of it's the defense of the yen. We don't think yield curve control is a really big deal at this point in time because we're not seeing the move in the Japanese late wage cycle as much as we've seen it in the inflation cycle. And then the rest of the economies, UK, India, Switzerland, Brazil, their liquidity is all rising. And so, you think about where global liquidity could be 3 or 4 months from now, you have basically the whole world fighting against the US and Eurozone. And so really what it comes down to is how much liquidity can the Chinese supply at this particular juncture? Go back to Q4 of last year, Q1 of this year, China and Japan combined to throw about $9-10 trillion into this global liquidity impulse that was obviously very beneficial for getting risk assets off the lows and really creating a lot of the positive outcomes that we're seeing on the tape this year. We're not going to see that same level of thrust because we're probably not going to see it from Japan as well, but we are going to see it from China. So I think the call on global liquidity, it's probably flat to down, based on everything we see coming out of the pike from all these different central banks and all these different economies based on their growth and inflation deltas.
That's interesting. So it sounds like you're not getting in the way of this equity rally, and it's certainly, or risk asset rally, and it certainly could continue. But I think you sound more concerned about what happens when we turn into the last quarter of the year.
No, honestly, I would just rephrase that. I sound like someone who's done enough research to understand how the sequence of the events should play out. We understand that we are in a pre-recession bull market that's consistent with dozens or decades and decades of U.S. economic and market research or history. But we also understand that that pre-recession bull market is going to conclude at some point and turn into what we call a phase 2 credit cycle downturn. And so my best, not guess, is, obviously we do hundreds of pages of research every month. So my best forecast of when the market is likely to peak is sometime in Q4 or Q1. I have a crystal ball on that, but it's July 14th here. Now the market's going to pull back. This is a stupid day to be buying stocks here. We're overbought. The measures of complacency are we got our friends at Longbow that the doomsday doesn't signal. It's at a max complacency level. This is a terrible day to capitulate if you're a bear. But the reality is, you probably, if you're running net short, you're probably going to want to use some weakness here to actually cover some shorts and wait to actually short, maybe a few months from now. I think this market this is not a new fresh bull market, a new fresh bull start of the economic business cycle. We still have a lot more of these mundane business cycle processes to go through. It's just going to take time, and we need to understand where we are in that process. So again, don't fight the tape. I think a lot of investors learned that lesson the hard way this year. We were fortunate to have pivoted back in mid-January when we did. It's just about being humble and respecting the fact that the business cycle is a process, the market cycle is a process, and it has nothing to do with the hot retweet on Twitter today.
Yeah, that is so true. Fantastic stuff. We're going to echo Jeff's sentiments, who said, "You're a legend. Love your viewpoint and analysis. Thank you for all your work and sharing with this community." And we feel the same way, Darius. I got to say, we did get some marriage advice for the newlywed from David, for Darius. But he says, Benjamin Franklin said, "Keep your eyes wide open before marriage and half shut afterwards." Now, that's just not funny advice to newlyweds, but truly whip smart.
I don't even know what that means, but I'm going to take it.
Me neither, Darius. I was going to say the same thing, and I'm not sure I concur, but it's hilarious, and I love it. Thank you so much. Congrats again, Darius. Just thrilled for you both.
Appreciate you so much, and I'll give everyone else some marriage advice, and this is advice from life. We went through with my youth pastor, actually, prior to our marriage. We went through like this sort of like pre-wedding counseling or workshop, basically.
Yeah, we call it pre-Cana, but yeah, we all have some version of that, I think.
That's pretty. Yeah, so I did that with my youth pastor, actually. I was grateful that he did that with us. And one of the things I learned in that, and I think it really resonated with me, because I think it's kind of how I knew to treat people.
Mm-hmm.
But I'll never forget. It was like, there's a verse in Corinthians, Bible verse, where it's like, do everything out of love.
Yeah.
If you do everything out of love, the whole world just makes sense, and the universe will take care of itself. Not everyone on Twitter is going to be nice to you. Not everyone's going to hold the door for you. But if you yourself control your own actions and do everything out of love, the world will be a better place.
That's a beautiful sentiment to send us off for the weekend. And I feel like so many people that cross through our Real Vision community do just that. And we're so grateful for it.
Appreciate it.
Thanks, Darius. Enjoy your weekend, everyone. We'll be back on Monday. I've got to step out again to take my daughter on a college visit, but Ash is going to be in the seat Monday through Wednesday. So he'll see you then. Take care, everybody. Good luck out there. Thanks for joining us, everyone. Today's Real Vision Daily Briefing is sponsored by Crane Shares. Learn about their KRBN ETF at craneshares.com/KRBN/Real Vision.